Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
So happy to have you along.
Yes, we are.
Sherry, tax time is over.
I know, thank
right?
goodness.
But you know that here is the shocking part. Tax time is over, but it also means 1/4 of the year is already over.
I can't believe that.
And there was a smart guy, I believe it was Einstein, that said the definition of insanity is to do the same thing over and over again and expect a different result.
Right.
Yet here's what I've noticed in the 29 years I've been in the industry. Your 1040 is done. You have probably moaned, groaned, complained, perhaps even puked when you saw the number that you had to write a check for or how much you paid in.
Yeah.
And now you throw it and file it in a drawer.
And don't think about it again.
And don't think about it again until it's way past December 31st.
That's what I'm
saying. And there's
saying.
nothing that you can do virtually to have any positive impact on your taxes. Folks, there is a reason I send out a letter in a very pretty colored outfit, or an envelope rather, in October. And it essentially says, if any one of these 8 to 12 conditions happen to you, your parents, or your kids, because I try to look at multiple tax returns, to come up with the best solution that I can for people. And that's not, you can't always do it. Some of us, my father's already passed away. Some of us don't have parents or kids that we can use. And some of us aren't comfortable asking their kids for their 1040.
Right.
But we can still generalize and we can still conceptualize to try to come up with ideas that best serve our situation, if you will. My point being this, that you've got to get that tax return back out, as ugly as it is, and become proactive. And there's always 3 numbers that you want to know for sure, Sherry.
Okay.
Line 7 tells us if you have earned income and how much it is. It could be on line 12 too if you're self-employed. Your AGI, the bottom of page 1, is going to give me some rules. And line 43 is going to tell me what your taxable income was. And that's where all the decisions are made. Your CPA gave you your effective tax rate. It's written all over your return. And that's what you pay on the average dollar that you made. Mm-hmm. When we're doing financial planning in the here and now, I have to worry about the marginal rate. That's what the last dollar that you earned or you had on your return that you paid taxes on. So I'm either working to get your marginal rate lower, or I'm getting money off your return, or to put maximized income on inside of that marginal bracket. That's what I have to pay attention to. And that's what you have to know how to do it. And keep in mind, itemized deductions are a strategy, right?
Yeah.
You have to, you get a standard deduction of $12,700, right? Or you can use your itemized deductions. So be smart about it. Many of our families double up 1 year on their charitable gifting, right? Double up on their paying their property taxes, and then not doing it the next so they can take the standard deduction. But you've got to be proactive. You've got to think this stuff through. There are 2 tax codes, my friends. People think it's one for the rich and one for the poor. It's really one for the informed and one for the uninformed. But if you learn this stuff and you don't do it, it doesn't do any of us any good, right? Pay attention, be smart, be proactive, and shoot me an email. Consider this at yourlifeafterwork.com. If there's any way we can be of service, please don't hesitate to let us know. Sherry and I'll take a break. We'll be right back into the show.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
Happy to have you along. Hey, for those of you who are new listeners to the show, I live in this culture of perma-beta. Andy Stanley is one of my favorite speakers and leaders, and he has always given us good things to do on the podcast to try to make the company better, to make the show better. I'm a big fan of Strategic Coach, where we try to make everything either bigger, better, simpler, or easier, and try to figure out the best way, Sherry, for you guys as the listeners to get value out of the show.
Did you say perma-data?
Perma-beta, always changing, always improving.
Perma-beta.
I believe, always have, that nothing ever stays the same.
That's true.
If nothing changes today, at the best case, I got a day older, right?
Yeah,
Nothing ever stays the same. And so we search out in our company how to improve things that are going on. And so I wanted to figure out another way to, I looked at the show that we do and said, hey, how can I take the show and make it even better for the end user? And, I still, if you're new to the show, I still teach this as a class. There's 5 segments, 4 if you're on WIBC, the rest of you on the other stations. There's 5 Central Indiana stations that are able to get the show, as well as iTunes. You can get that last segment off of our website at yourlifeafterwork.com if you're a WIBC person, and you can always subscribe or listen in another fashion. But the first 3 segments today are going to talk about concepts.
Okay.
Right? So we're going to talk about giving correctly, which means your charity or your kids get more and the IRS gets less.
I like
That's
that.
how I defined correctly.
Yeah.
Secondly, we're going to talk about reverse mortgages, whether they're a good, bad, or ugly idea. And then last but not least, we're going to talk about short-term versus long-term capital gains, what that means for your return and things that you need to be looking for. And then in the 4th segment, we're going to put it together in a case. We're going to talk about a family, and we're going to show you how I would think about it if I were in your situation. If you're new to the show as registered investment advisors, but I'm also a certified financial planner, I think in the form of checklists. So we don't have to figure this out every single time. We have a process to make sure that I's are dotted and T's are crossed. And one of those processes is what we call the fiduciary focus. So you'll always hear me break things down in the fees and into risk and volatility. That's the first one, fees and expenses, taxes today or tomorrow. And then the last but not least is making sure that you get a real return. That means something above 0 plus inflation. So the last 3 weeks, my newspaper column and one segment of this show has been based on that data. And again, we're going to do that a little bit today as we talk and we go through things.
Okay.
So the first one, as I said, is how do I give money correctly? And correctly, again, as I define it, means either your charity or your kids, your beneficiary, whomever
Right.
that be,
Whoever you wanna
get
give it to.
more and the IRS gets less. That's how I defined a good gift.
Because we said this before, a dollar really isn't a dollar. Giving a dollar isn't the same because you might lose part of it to the IRS. So
You might, and beneficiaries aren't the same.
Yeah,
not
right.
Not all beneficiaries are equal.
well, that's what I mean.
Right.
Yeah.
So let's use the first example. You're a single individual. You have no beneficiaries, and I don't know how I find or how these folks find me, but I have several very wealthy families there's just a mom and a dad. Well, not a mom and a dad, a husband and a wife. They have no kids, they have no nieces, they have no nephews.
Wow.
So it's all going to charity when they're done. And as I
Okay.
said, there's more than one of them. And so when money comes in the front door, right? When you take possession of that money, it's called a constructive receipt. And that's what the IRS is going to tax you on. If
You personally.
If it's hit my bank account,
Okay.
or if I have access to write the check or take the check, The IRS terminology is constructive receipt.
Okay.
Right? So when I sit down and I look at somebody's Schedule A, that's where you do your itemized deductions, right? The big three, Sherry, are state taxes. And obviously, if you're somebody listening in Florida or Tennessee or Texas or a few other states, you don't have any state income taxes. State taxes and plates used to be a bigger deal than they are now. The second one then is mortgage interest. And most of the time, when people come in that are retired or preparing to retire, the mortgage interest is minimal or even paid off. And then last but not least is your charitable deductions. Mm-hmm. So many times, and in one example, I've got over $1 million in an account. The lady refuses to spend the money. She does what she wants to do, but for all intents and purposes, she lives on Social Security. Huh. All right. And she makes a little bit of money on the side doing some things that she wants. All of the money is going to go to charity when she's gone, when God calls her home. So there's a couple things that I try to encourage her to do. Sometimes she remembers, sometimes she doesn't. One is don't take constructive receipt of the income. Your Social Security is taxable up to 85%. Now, when it first came out, none of your Social Security was taxable. Now, when I'm not talking about paying in now, I'm talking about receiving it. So you're over your full retirement age, and that check is coming in from the government every year that you paid into for all of those years. You didn't have to pay taxes on any of that money when you got it back. Then it became 50%, and now up to 85% of it's taxable. But Sherry, that is dependent on how much your other income is.
Sure.
So if your only income is Social Security,
right,
then for the most part, you pay very, very little in income tax along the way.
Okay.
Right? So her only deductions that she really has are the charitable contributions and this $12,000 to $13,000 a year of income that she tends to make. And there is nothing that says that $13,000 couldn't have gone directly to the charity, right? The way that the money's coming in. You may not be able to do this if you're working at a Walmart or McDonald's or at a hospital or a place like that. But when it's consulting income, which is what this case is, she could have. The other person could have written the check directly to her church.
Yeah.
If she would have done that, the church would have got the same amount of money. She wouldn't have paid Social Security taxes on the money, right? And she would have less of her Social Security that was taxed because of where her income was as a single filer.
Part of that $12,000 or $13,000, she's going to have to pay taxes on if she receives it.
Absolutely. She's still going to have to pay Social Security even though it's all deductible. This is not a wash.
I see.
It's deemed self-employment, so she's paying the 7.65% twice.
I know.
On both sides.
I'm self-employed.
And again, the church gets it. Now, when you're dealing with let's say she had kids, right? You can give $14,000 a year away to anybody you want, whether it's blood or not blood. And if you're married, you could each give $14,000 a year. The only deal is it has to be no strings attached. That means it's defined as a gift of present interest. You can do anything that you want to do. With the recipient has to be able to do anything that they want to do with that money when it is received. Now, every year, somebody asks me if they can deduct the money that they give away to their kids. And the answer is no. It has to be a 501c3 organization where the charities are there. But please pay attention on your tax return to Schedule A. Look to see what your itemized deductions are. You get $12,700 married filing jointly for free this year. If you're under 65, if you're over 65, it's even more. But you get that as an itemized deduction if you're married filing jointly. And many people, I will look at their Schedule A, Sherry, and they'll have $15,000 worth of itemized deductions, right?
Yeah.
Most of which are charitable. And so if we just reroute some of that charitable gifting, we'll get more benefit of the itemized deductions. Again, the charity gets more, the IRS gets less, and I call that a good gift.
Yes,
whether it's either for your kids or whether it's for your charities, folks, we've got to be smart about how we transfer assets from one place to the other.
Yeah.
And I realize I get paid to manage money. This has nothing to do with managing money, but part of our job is to make your tax return as clean as it can be, so when you sit down with your CPA, things are in better order, and we're able to keep more money for where it really belongs. Hey, if you got a question or comment, shoot me an email. Consider this at yourlifeafterwork.com. Sherry and I'll take a break. We'll be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along, Sherry.
Yeah, I have a question.
Okay.
So what we're really saying in our last segment was about how to give money wisely.
Right.
So it's not just about your tax return. It's about the person you're giving the money to, or the entity, or the organization.
I teach everybody when you can to look at 3 different tax returns. If your parents are still alive, look at your parents.
Okay.
If your kids are income producing, look at your children, right? And then look at yourself. Generally, somebody in there is in a higher tax bracket than the other.
Right.
And you never know which direction it is going to be, right? So, and I'll give I'll give the example as myself, right? My mother is retired, right? Has no earned income, essentially lives on Social Security, right? Lives in Florida. There's no state income taxes.
Yeah.
So mom takes the standard deduction every single year, right?
Okay.
Now, when she makes a gift to a not-for-profit entity, she gets no deduction. If she had mortgage interest, she would get no deduction because the standard deduction that she gets is greater than the amount of charitable gifting that she's doing.
So what should she do?
She should give me the money and say, Joseph, darling, it's less than $14,000. Here's the $14,000. Will you please write a check to this church or to that charity? And now some people say, well, that's kind of cheating the system. Well, you call it what you want. What I call it is being as tax efficient as I can possibly be. And yes, it's going to be on my return. I'm able to give the charitable gift and get a deduction.
So it helps
where she's
you.
not. It helps you. It helps me.
Right.
And so what I do when this situation works out is I actually gross up the gift by the tax savings that it benefits me. So again, the church gets more. I can't tell you that everybody does that.
True. Yeah.
But I can tell you that when the situation works, that you can really be smart.
Wow.
About your tax planning and things that are going on.
That's pretty cool.
The gifting is the same thing for the kids. Remember, when you're making a gift, the basis transfers. So we'll talk about that coming up in a moment.
Okay.
So here's I guess the title of this one ought to be Things Change, right? So
yeah.
I am one of the reasons people always ask me, what book should they read about investing? And
you have a lot.
And I am.
I'm looking at him.
Got a lot of books.
I'm looking at his library.
But I also tell people that unless it's a book that was written many, many, many decades ago, Benjamin Graham stuff, the Remnants of a Stock Operator, unless it's that, don't read the books that we write today, because by the time we write them, things have already changed. I'm much more a blog person, right? I hate writing newspaper columns to a degree that have opinions in them, because opinions can change.
Sure.
For instance, an annuity. You will hear me sometimes say annuities are okay, and sometimes they're not okay, and they're usually not okay about the time you want to go buy one, right? It's usually the wrong time. And there was an author that wrote for the Wall Street Journal that used to just pound variable annuities. So they were stupidest things ever. Nobody should ever buy one. And keep in mind, I don't sell products, so I'm technically agnostic. So you
can say whatever,
right?
Yeah.
And they would say, you should never buy an annuity. So a lot of people went through the 2000s and never bought an annuity. And then he comes out in 2000 and I don't know when it was, probably 4 or 5, and says, I was wrong. Annuities are better than what I thought, right? Probably the worst possible time to have been able to buy an annuity.
Right.
And so, again, we don't sell products. I'm just telling you things change.
Do concepts change, though? Just
it's not the concept. It's the way they're underwritten. It's the actuarial. It's the math behind it and some of the things that insurance companies do.
Okay.
Now, the reason I bring that up, because most of you are familiar with the term of an annuity. Right? Many of you have not heard of a reverse mortgage. And reverse mortgages are one of those things that were, in my opinion, sleazily sold to old people who didn't know any better.
Yeah.
That were many times desperate for needing income and cash, and they were bad products. And so it's easy once if you don't study this stuff all the time, it's easy to make that opinion, make that decision, and stick with it forever. And I did a segment on the show probably a year ago. One of my dear friends said, Joe, you really need to relook at this. I think it's a great idea now. And she was right.
Interesting.
And we did a segment on it. And so I wanted to cover the reverse mortgage again, both from the tax side. We just finished April 15th, April 18th for this year. And I just wanted to cover it real quickly. But the concept of a reverse mortgage is I'm 62 years or older. I live in my house and I need some extra income, right? And my kids don't care about the house. They don't want the house when I'm gone, right?
Okay.
So a reverse mortgage allows me to go to the bank and to get a loan against the equity in my home, but instead of me making a payment, they're going to make a payment to me. Now, that can be in the form of a line of credit where I can use it where I want to. It can be in the form of a fixed payment that they're going to send me monthly. It can be in the form of a lump sum all at one time if I wanted it.
Yeah.
I'm not going to get kicked out of my home, right? I'm able to live there as long as I want.
Because, and the reason that that's all true is because the bank gets the house in the end.
Yes. The house is sold when I either move out,
Okay.
or I'm dead.
Okay.
Right?
Yeah.
Moving out, by the way, is defined as 12 months, so you can still have a place in another, in Arizona or Florida or whatever.
Wow. Okay.
If you want to do that. Where it becomes questionable is when you're put into a nursing home. If something were to happen and
yeah.
I had to have long-term care and had to be in a facility, then technically if you're out longer than 12 months, the loan is essentially called.
Yeah.
And you either have to pay off the loan or sell the home. And then obviously just as normal, your family or you would get the equity that remained inside of the house. Now, the key thing from a tax standpoint is technically you're paying mortgage interest. Right? They're loaning you money based on the equity in your home. And we all say that mortgage interest is deductible. Well, remember, one, it's only deductible if you're able to itemize. So it's not always deductible. But the second part is if you're not actually paying it this year, it's accumulating. But if you're not paying it this year, it is not a deductible issue. However, when you go to sell it, right, when you go to pay it off, all of that interest could be deductible in 1 year. And here's where people really kind of get misguided or cheated, right? Because usually you sell it when you're dead.
Right.
Most people die in the homes, right? Because you don't want to go through all of the other hassle, and that's the intention. And they don't have, and all of that interest then is essentially taxable in 1 year. And many times people don't have the income to offset the deduction, and so the deduction is simply lost, right? That is one problem. Number two, if you went to a nursing home, you've probably got a lot of other medical expenses that are there, another large itemized deduction.
How does that work?
And not enough income to be able to take care of using the deduction, so it's lost.
So I know, it's a separate issue, but you go to a nursing home and you use up all your money, they can take your home in the end.
Sure.
But if your home is tied up in this kind of a reverse mortgage, how does that work? Because the bank actually has it.
The same thing that would happen anyway. Just look at it as having a debt against your home, right?
Oh, okay.
If I went to a nursing home today,
I see.
The bank owns about half the house. I own half the house, right?
I see. Okay.
It is however it works, and it's
Okay.
factored into the system. My point is this, that things change. Reverse mortgages are certainly not for everyone, but they are for some people, and they do make sense. I found it interesting as I was doing my research, you can even have one that is a 2 to 4 unit as long as you live in one of the units. So if I wanted to move on a college campus and live in one of the units and rent out the other 3 units, I could do the same thing if I wanted to do that in my later years in life, kind of make them cook, clean, and mow.
Yeah, why not?
And one of those things. So key things, age 62. But the real thing here is, folks, things change. There are good things, there's bad things. There is no one wrapper where you can say this is always good or this is always bad. It would depend on the situation. That is everything with the fiduciary focus, right? Risk and volatility. So there's not a lot of volatility here. You know what's going to happen.
Right.
Fees and expenses, make sure that you understand what's going on. The taxes, you really have to understand because a lot of mistakes are made there. And obviously the real return, you're using your assets in some cases correctly if this is the right deal for you. Hey, you're listening to Consider This. I'm Joe Clark along with Sherry Contos. Yes, we manage money for a living, but there is more to life than just the assets. Pay attention to your money and be wise. Shoot me an email, considerthis@yourlifeafterwork.com. We'll take a break and be right back.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. Sherry, there's a lot of talk going on about changing the tax code and the complexity.
Well, yeah.
And it is very complex. The last major overhaul, it's true overhaul, started a year before I started my career, 1986.
Yeah.
I started 2 weeks before the crash in 87. And so it's been a while. This is 29 years, and it's been 30 years since we've had our last major overhaul. It is a tough thing to get done.
Well, who does it? Anyway?
Congress. Congress and the Senate have to approve it.
Somebody has to
Ways and Means
design it.
Committee is the one that actually does the designing. But that's what President Trump is trying to put forth, and you hear, the different people have their viewpoints of what's going on. But we're looking at a major overhaul. In the meantime, there are changes that are made that prevent opportunities and distractions, things that get confusing. Because when you move a little piece, if you don't think about all of the other moving components, you can get into trouble. Anybody who knows us well at the Financial Enhancement Group knows that I'm a Roth fanatic. I love tax-free money. It makes my heart smile. I help people who are told that they don't qualify for a Roth IRA. I help them get Roth IRAs, not by doing anything illegal, deceitful. I use the tax code the way that is written, Sherry. There are two codes, one for the informed and one for the uninformed. Right.
Yeah.
And so I'll have people who come in. I had 2 CPAs call this year and say, Mr. Clark, you're mistaken. The client can't have a Roth IRA. And I go, well, actually, I apologize, but you're mistaken. Here's how they can have a Roth IRA, and here is why. And then I help walk them through, and they go, I never thought of that. I go, I know, we do different things. At the Financial Enhancement Group, I do tax planning. I help people prepare for that next year, and I still use a very, very smart CPA with E-Step Doctor and Company if you're on the east side of the state, Huth Thompson if you're on the west side of the state. I still work with CPAs that do the tax reporting that is important, and we work with them to do the tax planning. So many of the meetings that I have with the families we serve, there's a CPA, a planner, and a paraplanner in the same room working on your stuff so that we stay in good fashion together. But what I want to talk about here is really the impact of long-term capital gains and how it works for you. So when we look at your tax return, Sherry, one of the things that I'm going to look for is to see if you have a carry forward loss. Now, if all of your money is in IRAs or 401ks, then you have no carry forward loss. A carry forward loss is a loss that you have in a year that is greater than $3,000 and that you're unable to deduct until you have future gains.
Where would that be found on a tax return?
On page 1, if you look in the middle, you're going to see where it shows if there's a negative $3,000 on the notes, spot on. I guarantee you have a carry forward loss. And you're going to look back, and it could be 5 or 6 pages back in your return, depending on all the schedules. But it's going to show you what that carry forward amount is. So let's pretend like you have a $50,000 carry forward loss, Sherry.
Okay.
All right. And you can tell when you look at your return, you can deduct all of your losses up to all of your gains plus $3,000. So you've got that negative $3,000 on your return. You're deducting it. So now you're down to $47,000 of carry forward loss.
Okay.
Well, we made a change a few years ago that if you were in the 15% marginal bracket, right? So go to page 2 of your return. Look at line 43. It's going to tell us what your taxable income is, right? If you are married filing jointly, and that line 43 is below $76,000, it's a little bit more than that, but below $76,000, then you are in the 15% marginal tax bracket or less. If you are in the 15% marginal bracket, you pay no capital gains tax on long-term gains. Very, very, very important to understand.
Yeah.
Right? Now, here's the problem, Sherry. You've already got a carry forward loss.
Okay.
So the way the process works is the IRS is going to actually confiscate part of that loss.
Why?
Because that's the way the system was set up. There wasn't anything to put. There wasn't anything to stop that.
Okay.
Right? So you're unknowingly eating your loss while not getting any benefit for
from
it
it,
because
yeah.
you were already in the 15%
So it's
bracket.
really a loss. Ha.
And so it becomes very, very important if you're going to use that loss, and if you've got gains. So again, we're not talking about IRA or 401k money here, right? We're talking about you've got a brokerage account, you've got a stock that's got gain in it.
Yeah.
Right? Then you need to be able to make sure that gain takes you to the 25% bracket so that all of those losses can actually be used and manipulate the tax code in that way. You've got to be proactive about this, though. And it's, some people say, well, Joe, that's an awful lot of a hassle. Well, let me put it this simple here, right? If that carry forward loss, if you're ever going to be in the 25% bracket, right? If you're ever going to be there, and it's almost a $50,000 deduction, this over complication that you may be thinking about just saved you $12,500 potentially, depending on what bracket you're in. Cash money, hard earned.
Wow.
Now, some people would say, well, Joe, it's only a 20%. Okay, so it's $10,000, right? I mean, this is still worth doing, even if it was only a 10% savings.
Yeah.
Right? It's still $5,000. It is absolutely worth saving. So here's why I believe people have to proactively manage their money. It's why we do both at the Financial Enhancement Group internally. So as a certified financial planner, I see the families we serve. My planning team sees the families we serve, but we also manage the money internally because what shows up on your tax return does matter. It does matter. And so you may have been here when we had the good news and the bad news one Monday morning when I came in to tape the show, where we bought a company called, it was a pet veterinary clinic.
Yes.
Where they had a massive thing. Ticker symbol was WOOF. You gotta like that, right?
Yeah, I do.
And somebody else like us liked it too, right? So they bought the whole bloody company. And
Sure.
as a result, we had to pay short-term capital gains, which just makes my blood pressure go up. But when you buy good companies, every now and then they get taken out.
Yeah.
Now, as another example, and here's where the money manager part of us comes into play, we bought another company that I still own some for another week, so I can't tell you what it is. But we had about a 50% rise inside of the stock. We don't try to hit home runs, folks. This is not normal. I am not bragging about our gains or returns. Please do not take it that way.
Right.
We bought a company. We bought it right. The stock happened to have a big jump, did very, 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 very well. And it became too big of a percentage of some of our people's accounts. We don't ever let a position go above 3 to 5% of an individual's account, depending on the situation. So inside of the IRAs, we were able to trim it and take profit because there is no such a thing as a short-term capital gain in an IRA or a 401k. Right? However, we have a lot of families that are where the money is after tax. It's in brokerage accounts, right? It is subject to tax. And even though we want to sell it, we were 30 days away from it becoming a long-term capital gain. That means if you're in the 15% bracket or below, you're not going to pay any taxes. And folks, I do have millionaires, people with more than $1 million in an account, who are in the 15% bracket. It does happen. Just so you know, this is about tax planning, not about tax reporting in this case. And so we have to very carefully make those sales so that the people's returns will not reflect a short-term capital gain, which would be taxed at their ordinary income rate. Right? It'd be just like adding interest or income on the return, not subject to Social Security, but taxable income. Or we wait for 30 days. And even though the stock may go down 1 or 2% or 3%, it's worth people not having to pay the full short-term capital gain.
Yeah.
You don't see that on your investment return. When you look at your returns and your statements, you don't see that. But that's what tax-efficient planning does. And that's why the academics and the white papers show that the stuff that we do here and other places that are very tax-efficient and sensitive add as much as 1.5% to your overall return every single year.
Sense.
You've got to be smart about how you deal with the tax man, and your investments purely and clearly go into that column. Hey, you're listening to Consider This. I'm Joe Clark along with Sherry Contos. We'll take a break. We'll come back and we'll show you how to put all this together.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along. Well, Sherry,
Yes.
years and years ago when I taught at Purdue, I think it's been 4 or 5 years now, but I would drive to Lafayette. I've got a big office in Lafayette as well, and I'd drive across the state, and I would go teach the kids the capstone course in financial planning. Purdue's got a 4-year degree in financial planning, and I was the one that got to teach the last class that brought it all together.
That's
called
cool.
the capstone. I thoroughly enjoyed it. 7 years,
Yeah,
14
it's neat.
semesters. One week it snowed. I know that happens in Indiana. You know.
Oh, yeah.
And I couldn't get to the class. I live in Anderson, and so I essentially said, "Hey guys, I'm going to do a case for you on the radio, and you guys listen to it, and then we'll solve it next week." And I did that for you guys as the listeners, and it was one of the most commented shows that I ever had. And so I thought we would do that, just real briefly here. And
case
kind of
study.
start a trend for the show saying, okay, here's the 3 things we talked about today.
Okay.
Right. Reverse mortgages, short-term and long-term capital gains, and how to gift correctly.
Sure.
Right? So in this case, we're going to pretend like we have a 68-year-old couple. Couple means they're married filing jointly. They give away $20,000 every year to their church. They have $40,000 in carry forward loss, and their only income that is recognizable right now is Social Security. They've got a $1 million portfolio with $400,000 of long-term capital gains. They have a home with $350,000, and they would like to they would like to increase their income. They also have a $500,000 IRA.
Increase their income above Social Security?
Yes.
What? Okay.
So they want to know the best way to do it, right? So they're looking at the $400,000 worth of long-term capital gains, and they're a little bit scared of going that way. They love their kids, and some of these stocks they really, really want to keep. So a couple issues. They're only 68. So when they're 70, normally I would look at a $500,000 IRA and I go, hey, this is kind of scary. You're going to have required minimum distributions. In their case, it would be about $17,000 a year that I would have to add onto their tax return.
Wow.
Starting when they were 70. But that's no big deal because they give away $20,000 already. Right? So when they reach age 70 and a half, you can't do it before then, we'll be able to do qualified charitable distributions, QCDs.
Okay.
The money can go directly from the IRA, which satisfies the RMD, goes directly from the IRA to the church.
Okay. Right.
So we're not going to put any taxable income on their return, which keeps their Social Security lower.
Okay.
And they will no longer need to itemize, which means they can take the full use of the standard deduction and, again, have a much more tax-efficient return.
Wow.
In the next 2 years, however, we need to be gifting, right? In those stocks, many times people have portfolios of stocks that have been around a long time. In northern Indiana, it's a lot of bank stock from little banks that have grew to bigger banks that grew to bigger banks. And their basis, that's the amount that's already been taxed, is very low, where the growth is very, very high, right? And in this case, what they should be doing is gifting the shares of the stock directly to the charity. The church in this case, sells the stock. If the church does not have a brokerage account, we open up for them one for free at the Financial Enhancement Group. I go to TD Ameritrade. I do it on our dime. So it's all set up. The stock transfers to the church account. The church account sells it. Churches don't pay taxes, right? You pay no long-term capital gain. You get the full deduction in this case
On the gift.
for the fair market value of the gift, even though you recognize no capital gains.
Wow.
It is a beautiful, beautiful way to go. And keep in mind, if they wanted to make gifts to their kids, right? If they wanted to make gifts to their kids, the basis of the gift transfers with it. So if my daughter were 25 and she's in the 15 or 10% tax bracket, she pays no taxes on long-term capital gains. If I gift her a stock that has that's long-term, that means I've held it for longer than a year and a day.
Yeah.
Right? And she sells it. Her basis is my basis because I made the gift during life.
Yeah.
Right. But she sells it and she's in the 15% bracket or below. She pays no long-term capital gains. So it's a beautiful, beautiful thing to go. They want more income. Well, one of the best ways to do it on that return is not through interest. It actually is, and based on their situation, only living on Social Security income of $45,000, they are in the 15% bracket, right?
Yeah.
Because of their deductions that they were taking, they were actually in the 10% bracket. But now, if you systematize, you don't want dividends. That's taxable income that's going to go on the return unless they're qualified dividends. Then they'd be okay. You don't want interest, is what I meant to say. That's coming from a bond or something like that. Dividends and qualified, meaning dividends, and income that comes from capital gain recognition within a moderate amount can let them raise their income, and they don't have to worry about paying the taxes. Right?
Wow.
Wow.
It sounds very complicated to me.
It's not. It's
moving pieces.
It's a matter of going through the formula, Sherry. You don't want to increase risk and volatility.
Right.
The fiduciary focus. I don't want to increase risk and volatility. They've got a bunch of money in equities that they probably wouldn't have if there were no tax impact. So use liquidate either via gifting or through the amount of income that they're going to recognize. Liquidate the weakest positions in your portfolio, the ones that need to be changed the most. And before I forget, fees and expenses, there are none, right? I mean, You're using your own money. None of this is changing anything.
Yeah.
Some people say, Joe, it cost a bunch of money to trade stocks. Cost $6.95 for me to sell $1 million or $100,000 or $5,000. It's $6.95, folks. It's not making stock trading anymore is not that expensive. As long as you've got the right contract. I had somebody once tell them that at a brokerage firm they're going to charge them $3,200 to sell stock, and I did it for free just to prove a point.
Yeah.
It's don't get caught. Don't let the little things cost you lots and lots of money.
Yeah.
Right.
Yeah.
Anyhow, when you're looking at the stuff that's inside of your portfolio, you want to make that decision and be right about what you're going, but do not ever forget the tax man, the taxes both today and tomorrow, right? So I'm looking at 2017, and based on the strategy we just laid out here, again, 68-year-old couple, we know in 2 years they're no longer going to have any itemized deductions because we're going to use the qualified charitable distribution to give the credit to their church, right?
Right.
And so in this year, what I'm going to have them do is pay the 2017 and their 2018 tithe. So instead of giving the church $20,000 this year, they're going to give the church $40,000, knowing that that's the tithe for next year.
Next year too,
and then the year after, they're 70. They'll be able to have more of their money effectively that they're able to itemize, right?
Yeah.
And then next year, they'll take the standard deduction because they won't have any deductions. The church got the same amount of money. The only people who lost in the deal were the IRS. And if you sit down and you really think about this, pay attention to that fiduciary focus, risk and volatility. You want to make sure that that's under control. Fees and expenses, taxes, but it's both today and tomorrow and real return. If you look at those four, you can put this together in a way that benefits you every single time. There are tax planning strategies that just flat out work, and there's nothing about that that's illegal.
Right.
It's just being smart and focused and diligent about how you move forward in the world. Folks, you're listening to Consider This. If you're with us as part of our WIBC family, this is the end of the show for you guys today. But if you have a question or comment, you can shoot us an email. Consider this at yourlifeafterwork.com. And of course, you can go to the website at yourlifeafterwork.com to find my newspaper column. The fifth segment that's coming up here in a moment, Sherry. What are we going to be talking about today?
I'm not going to tell you. Then you would know.
Okay,
I can't tell you.
She always surprises me.
What says
Joe? But love to have you. Again, questions or comments, shoot us an email. Consider this at yourlifeafterwork.com. We're more than happy to sit down with you, share a cup of coffee, and see if we can take some of these tax planning strategies that we've talked about and mix them in with your investments to find the best way to maximize your money. 2 tax codes, folks. One for the informed, one for the uninformed. Let's do this together.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Happy to have you along.
Yes, we
Oh,
are.
Sherry, you got this big old grin on your face.
Well, I love this part because you don't know what it's about. So anyway, yeah, this is What Says Joe. And today, you actually already hinted, like you usually do, about what I want to talk about today.
Well.
But anyway, here we go. So it's springtime. And
Golf time.
well, for some people, yeah. But I know a lot of people, and every spring they start, and they do this automatically. They start driving around and looking at houses that have for sale signs in the yard, and wondering, is it time to downsize? Is it time to buy the next house up? Is it time to sell my place, get it, make a profit, put it in savings? Is it time to blah 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 blah? So I just wanted to go back to that a little bit. My son's a realtor. I've mentioned that. Not my son. My son-in-law is a realtor. My best friends have decided it's time to sell their house, so they've been on a big swing to get it cleaned up and get it all ready to sell, and move to something smaller. And so I wanted to know your thoughts on. We've talked before about the fact that you personally don't always think it's a wise idea to buy a house.
Correct.
However, the general public right now kind of does.
If you're not going to live there for 7 years, and
Right.
that's primarily when I'm talking to my college students,
Yeah.
and for younger families. If you're not going to live there for 7 years or longer, I don't believe in a normalized economy that it makes sense for most of us to buy. What we call carrying cost, the realtor fees, the property taxes, the upkeep on the water heater and the roof and those kind of things. And then the lack of opportunity to move because of disposition when you go to sell it.
Right.
You can't control when another buyer is going to be there.
Okay.
And so I think when you weigh out all of the costs and the opportunities, if you don't believe you're going to be there for 7 years, I wouldn't buy it. Right?
Okay.
And today we live, and I would tell your kids, today we live in a much more transitional world. Most people don't work one place for 30 years like I have.
Right.
They work in various different places, which causes them to move.
Right.
Right.
But we've also talked in this show about buying houses as an investment to use as a rental. I mean, someone has to own these houses. GMP a lot is driven by home ownership a lot, that industry. And so someone has to own the houses, and we're talking to people that may have the wherewithal to do that.
And there are professionals that are out there that, I've got a couple clients that own 40 or 50 units.
Right.
And one a lot more.
Right.
And so yes, but they're in the business. They've got a handyman on call. They understand how to properly price it. That is their business.
Right.
That's Joe is not going to have a house that he rents out to somebody.
Right.
Right.
So my question is, if you are, the other thing I wanted to mention too is I've been reading articles on what they seem to think is a crisis about millennials not buying houses, wanting to, not being able to, or not having an interest in. And so I'm wondering, what does your financial situation have to be in that millennial age group? But also, what does it have to be when you get to be like my friends? They need to downsize, whether it's a good time financially for them or not. They can't take care of their property anymore.
Right. So let's do two things.
Okay.
Let's hit the millennial first.
Okay.
The biggest challenge with buying a home is, one, it requires some money down, and most of them don't have that. But the bigger reason yet is the credit, the debt to income ratio.
Right.
Because most of them are walking out of college with $20,000, $30,000 worth of debt because somebody thought it would be a good idea for them to get a degree, even though it's nothing that they're using in their career.
Right, exactly.
We've never had it this high, but fewer people are using their degree than are using their degree that are coming out of college today. But they still have this debt. And if you're not below, 35, 36% debt to income, so you take your monthly obligations, right? That would be the
Okay.
house payment, the car payment, student debt payments, those kind of things. Take that debt into the amount of income that you have on a monthly basis. That'll tell you your ratio. And it's got to be below 40%, counting the new house payment, property taxes, and the insurance. It's got to be below 40 or you're just going to have a really, really tough time getting a loan.
So what about, but what millennials don't have a long job history either. So
No. But the job history is not as big of a challenge as the debt to income ratio is
Really?
right now. They almost have changed it. When you and I were leaving school and going into the workforce, they cared about our job history.
Yes.
Here, if you have a degree and you happen to be going into something that you studied for,
Right.
they almost give them credit, right? So that they've got it. Now, with the older people, the downsizing is fine as long as you understand the rule, and that's rarely do people spend less to downsize. They almost always buy a nicer place.
So they spend the same amount of money, but they don't have as much land, or
It's usually more.
really?
Yeah, very, very few people actually go to a cheaper place. And there's a couple of reasons. One, the old furniture doesn't come with it. The old furniture tends to stay in the old house.
So they start over.
They redo it the way that they want it. It's just, in my experience, rarely is downsizing mean less expense. It just
Right.
means a smaller facility.
Yeah, but if they have to do it,
They have to do it,
So
sure.
what do they need to get in line, and how much money down, and all that stuff to not mess up the rest of their financial planning?
It depends on what they want to do. As long as they haven't had more than $500,000 worth of gain in the house, right, which is really tough to do for most of our listeners here in Indiana. As long as you've not gone over $500,000, there is no income tax that you have to worry about.
$500,000?
Of gain.
Okay.
So if you bought a $200,000 house and you were selling it for $1 million, right, you'd have to pay a little bit of taxes.
Sure.
But if you bought a $200,000 house and you're selling it for $400,000, there's no tax that you have to recognize off of that part, provided you lived there 3 of the last 5 years, right? So the one thing that somebody needs to consider is if they sell this house, it just happened to a friend of mine, they put their house for sale because they wanted to be prepared.
Right.
And 2 days later it sold.
Well,
and
I
they
know
had
that's
to be
what's
out of their
happening.
house before they were able to get the other one
Right.
closed.
Yeah.
So you want to be smart. Not everybody can afford to have 2 operating at the same time.
True.
And if you're going to do that, the bank's going to want a larger down payment if you can't pay cash, right? So many times it's 20% down,
Right.
for the second one. You want to put down enough to avoid what's called PMI anyhow, private
Right.
mortgage insurance. That's never for you. That's always for the banks. But if you don't put down a large enough percentage, you get caught paying PMI.
Right. So do you ever think, because I read a whole article about borrowing from savings to buy a house, or you're making a choice. If you're younger, I'm going back to them, you're making a choice between putting money away or putting money into a house. We talk about the accumulation phase. Of finance.
You're just never going to get me to say that that's a good idea. I mean, it's houses. I used to tell people were estate tax liabilities. I don't say that anymore because the estate tax code changed. But whether I'm in a 5,000 brand new square foot home or whether I'm in a 1965 house with 1,000 square feet, I am still shaving and showering and eating.
Right.
It's a cost, and you pay a cost to be able to say where you live, to be able to know that it's yours, et cetera, et cetera. I don't believe the benefits outweigh the cost unless you know you're going to be there for an extended period of time. And I think we live in a transitional world right now.
Right.
So I do have people who are older that have quote unquote downsized, right? That I get to rent as opposed to buy another property that they're not going to be in that long potentially, or that their kids have to deal with when they're gone. There's nice places out there you can rent.
And you think that's a good idea?
I actually, yes.
Okay.
They don't know if they like Arizona. They didn't know if they liked Florida.
Okay.
I've watched people move to a house and then have to move again for
I
health
know.
issues
Sure.
or different things that come up. I think we have to deal with that life is just transitional, right? And be smart about it. Be smart about your money, and be smart about your opportunities that are out there, and just weigh them out. One of our expressions when we look at companies that we're thinking about buying in terms of a stock is there's always going to be another stock, right? If the deal's not perfectly clear,
Right.
then we don't go there.
That's hard with the house, though, when you see the perfect house, and it's kind of a bandwagon situation right now going on.
It is. Hey, you've been listening to Consider This. I'm Joe Clark along with Sherry Contos. This last part is aimed for you to help Sherry bring in ideas and things that, not everything is black and white. Some things are gray. We've all got different opinions and
Right.
different ideas, and there's nothing wrong with that. shoot me an email. Consider this at yourlifeafterwork.com.
Welcome to Consider This with Big Joe Clark. Joe is a certified financial planner with more than 28 years of experience in the financial services industry. He serves as the managing partner of the Financial Enhancement Group, LLC, and also taught financial planning at Purdue University for 7 years. The Financial Enhancement Group is an SEC-registered investment advisory firm based in Indiana with more than $200 million in assets, serving clients in more than 20 states. Indiana offices are located in Anderson, Fishers, Lafayette, and Rensselaer, as well as Sonoma County, California. This show is for educational purposes, and you're strongly encouraged to consult your advisor regarding your individual issues and opportunities. Joe can be reached at 800-928-4001. You can find more information about Joe and the Financial Enhancement Group at yourlifeafterwork.com. Enjoy the show, and remember to consider this.
Good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Cantos.
And we are plumb tickled.
We
you
are.
spent the fastest hour in radio.
It goes so quick.
It just baffles me. It really, really does.
I know.
You know, it is part of the deal. Sherry, you hear me reference Andy Stanley on this show.
I do.
All of the time.
I like Andy too.
I do my best to give you guys value and stuff in this show to try to change your lives. And there's a couple formulas I've learned in my life. One came from the strategic coach that said a mess is when you have an obligation without a commitment. So the formula is M equals O minus C. Whenever I'm doing anything in the not-for-profit world, I always pay attention to that. But the other one came from Andy Stanley, and it really has changed the way that I try to do this show and the way that I try to do a lot of things in my life. And that is that the Q multiplied by A equals E.
The Q.
The Q is the quality of the idea, right?
Okay.
The how good or how strong this really is.
Okay.
The A is your adoption of it, your usability of it, right? And then the E is the excellence, what value really came from it. So I would like to lay out perfectly good tax planning strategies on this show. I'd love to teach you how our risk barometer works, how we're able to manage money successfully. But if it's so confusing and so complex that you have no adaptability, that you have no ability to put it to use,
right,
then we have no excellence.
True.
You guys wasted your time. I wasted my time. We didn't get to meet each other. And the IRS still gets more money than they ought to, right? So the idea is I try to take some of this stuff on the show and make it a little more simplistic than I would like to, so that your adaptability is better, so that if you're choosing to do this on your own, at least you have something to work with, and we have value and excellence. If you're choosing to come to see us and we welcome you to do that, then it's going to be turned up a notch. It's a little bit more than what you hear on the show, but we're there, we're doing it together, and we can make sure that adaptability and the quality are multiplied together so that we can have true excellence. Let's not let another year of your life go by where investments aren't taken care of and the tax man gets too much of your money.
Yeah.
Hey, if you got a question or comment, shoot us an email. Consider this at yourlifeafterwork.com. Don't forget to go to the website at yourlifeafterwork.com. You can find my newspaper column and other radio shows from the past. Folks, we wish you a wonderful, wonderful weekend. Take care, and we'll see you again next time.
Thanks for listening to Consider This with Big Joe Clark. Joe can be reached at 800-928-4001 or via email at bigjoe@yourlifeafterwork.com. The Financial Enhancement Group, LLC, is based at 429 East 14th Street, Anderson, Indiana, 46016. Be sure to check out their website for more information at yourlifeafterwork.com. Have a great